Welcome to Your Pathways to Wealth, the podcast where we explore what wealth truly means, because it's different for everyone. I'm Charles Massimo, and along with my partner Peter Anastasian, we'll dive into strategies, stories, and insights that help you define, grow, and enjoy your wealth on your terms. So let's navigate this journey together.
Join Charlie and Peter and their guest experts as they venture to help you continue to grow your wealth.
Peter, how are you?
Good. How are you? Happy 2025.
Yeah, you can see me with my bulky sweater. We're getting pretty cold out there.
Yes,
I think we're like 20 degrees today. So it's this is when I say I get why people go to Florida for January through March.
No question.
Yeah. So today we're going to talk about a topic that may bring clouds over many of our listeners. But we want to dive headfirst into a topic that's both unnerving and essential, really, to confront the looming 2030 depression. Peter, what do you think what's the initial reaction when you think people hear 2030 depression?
Well, for some, I think it'll certainly catch them off guard. And for others, I think you're starting to hear some of these headlines circulate. But I think it's important for us to certainly level set. Because as you know, Charlie, you and I were definitely, optimistic individuals. And certainly when we deal with our clients, we're very optimistic. So we don't want to portray us as being such negative individuals. But there's a huge difference here to your point. So 2030 is definitely a headline that's been circulating.
Yeah, Peter, I really agree, because all our writings, right, everything we say, don't panic out of the markets. It's the worst mistake you can ever make. And certainly we're not saying panic out of the markets here. All right. I don't think we would ever say that. But Peter and I firmly believe that the writing is so clearly on the wall. And one group in particular, and for many of our clients, this is not new. You've heard this from us before. Because the one economic forecasting firm that we have followed for the past decade or so is ITR Economics out of New Hampshire. And they have been ringing this bell for over a decade now. And by the way, I wish we knew them prior to 2008, because they were the first ones, well before anyone else, to call 2008, well before 2008. So they're talking about this now. Peter and I have participated in a number of their webinars. So why should you listen to this? Well, as I said, ITR Economics is the oldest global leader in economic forecasting. They have a 94.7% accuracy rate. That is pretty phenomenal. They've been doing it since the 1940s. So this is nothing new. They've been around for a while. And believe me, they have nothing really to sell. They're not selling funds. They're not selling investments. All they're doing is helping predict or forecast what the future holds. And again, Peter, we've listened to how many now webinars with ITR Economics on this topic?
Oh, this has been going on for many years now. So we've definitely been following them for the past definitely 5, if not closer to 10 years at this point.
So today we're going to kind of talk about the 5 drivers of the coming depression. And then in future seminars or podcasts, webinars, whatever we're going to be doing, we're going to talk about strategies that we're thinking about implementing for our clients. And again, this is not one size fits all. It's always dependent on where you are in your life, where you're looking to go, because at the end of the day, everything we do is about risk management. Right. And certainly as we get closer to 2030, we're going to talk about ways and certainly with ITR Economics guidance on things that we should be doing. But let's talk about the 5 drivers. And Peter, why don't you comment on each as I bring them up?
Sure.
Right? So the first driver, and again, these have not changed. If anything, they've just really reinforced why these drivers are so important. So the first one is demographics. They say that the world's population is aging and the working population will be smaller in the 2030s. This will lead to labor shortages, fewer taxes to support the older generation. So that's the first driver, Peter.
Yep. And again, I think it's pretty clear. We all know the term baby boomers, and they're coined for a reason, because there was a baby boom. And so there's more baby boomers than truly any other age group out there. So at this point, they're sort of peaking right? They're coming to a peak, and ultimately they will start exiting the workforce from this moment on.
Yeah, and again, that's why they're saying it's world population. It's not just in the U.S. You could see what's going on in China already. The
Yep.
difficulty they're starting to have now after many years of really a controlling economy that was thriving, right? But they're seeing the same issue. So demographics is number one. Second is healthcare costs. I mean, just think about it, right? I have two boys with autism, right? My healthcare costs are through the roof. But everyone we talk to complains about what? The care of health.
Mhm.
It's not just the care of the cost of premiums. Just think about Medicare now. And for many clients, the more you make, the more you're going to pay in Medicare premiums. So you can't escape it when you retire. So the elderly, we're living longer and demand more health care, which increases costs. And Peter, we have so many physicians as clients, and we talk about this and they talk about this all the time.
Yeah, I mean, they always stress the fact that labor wise, they're stressed, meaning the capacity at which the demand of services are needed versus the ability to service. So there's stress on that end of it. And the rising costs across the board, whether it's medicine in general or as well as labor, as well as overhead. So when you look at all those areas, it's only going to contribute to the impact of cost and ultimately uh, pass on to the individual themselves.
Third factor, entitlements. I'm sure everybody is starting to read this more and more. Social Security and Medicare, not sustainable. How many times have people asked us, Social Security, is it going bust? Well, we certainly don't think it's going bust, but it will absolutely change. And we ourselves are going to have to fund our retirements to a much greater level, understanding that Social Security just cannot be there to fund it at the levels they're currently funding. I mean, just think about it. Because we're living longer and longer, people are collecting Social Security for so many more years and Medicare for so many more years. So again, Peter, entitlements, and we already have clients asking us this question because so many of them are approaching the age where they'll start collecting Social Security.
Right. I mean, just over the past couple of days, we just heard of even more entitlements to those that are currently on government pensions and now, increasing their Social Security benefits. So that's just going to continue to impact and stress the Social Security pool of assets that they have available. Look, over the next 10 years, we all know, I mean, it's pretty much a given that Social Security is going to run out of money unless there are changes, whether it's extending the age at which people retire or the ability for those to or them to contribute additional dollars into the system. So unless there's a change, we know where the direction is and where it's headed.
Yeah, and this may change the way people think about when they should collect Social Security. Our old advice, and I say old, only a week ago, maybe, but we normally tell our clients, hey, wait till the longest possible time to start collecting Social Security. But wait a minute, you're telling me we may run out or things are going to change. Why should I wait? And that's a real fair question, and it will certainly play into how we guide clients on when they should start claiming Social Security benefits. Unfortunately, Peter and I have a great partner. All he does is Social Security planning with our clients. And our clients are always fascinated by the conversation. He has this great heat map. This is the perfect time to take Social Security for you and your wife. But certainly, I think going into 2030, we may change our thought process as we get closer. The next one, and listen, we have all felt this through COVID, is inflation. We have lived so many years with tame inflation. Then all of a sudden, a couple of years ago, it spiked and it has not come down. Now, it may come down somewhat, but as we get closer to 2030, as the economy continues to expand again, which it will, right? What's going to happen to slow it down? Rates are going to have to go higher, right? That's going to cause inflation. So, Peter, just think about it. We joke about it all the time. You go to McDonald's and it costs $50. I mean,
Oh yeah. Oh yeah.
It's crazy. So inflation is going to have a major impact.
Yeah, again, no, inflation is across the board at every level, whether it's at the supermarket or even on a luxury item, watches, for many, it's very difficult to purchase a luxury, watch, for instance, on a special occasion, and even looking beyond, more so on homes in general. I mean, limited supply of homes, and inflation is certainly here. We're all feeling it. The projections were that interest rates were going to drop quite a bit, and they've been pretty stubborn in coming back down. And so I think the mindset is now changing, and the shift is that inflation's fairly stubborn and most likely here to stay, and stay for a while.
Yeah. Peter, you're gonna have to sell off some of your luxury watch collection.
Yeah,
I know
right.
you're upset by
I wish I
that.
had one in the first place.
Right. Um, and the last one, as far as how ITR Economics is looking at it, is the national debt. Again, it's hard for anyone to sit here and say any of these 5 factors are not accurate or they can't see it. Our national debt is above $30 trillion. And this is not a political statement. I don't care if it was Joe Biden, Kamala Harris, Donald Trump. It does not matter. The debt is only going higher. And how do we do that? The only way, or one of the only ways to help that, is increase taxes, right? But does any politician want to run on a platform on increasing taxes? I certainly believe, and Peter and I believe, that taxes only have one way to go, and that's up. And you certainly have to think about it, and you have to plan for it. But there's no way they can raise taxes to the level that's really going to do a damage to our national debt.
Yeah, I mean, that has certainly climbed. I mean, COVID definitely, triggered that quite a bit, and the spending hasn't really stopped ever since. And so, when you look at GDP versus government debt, it's at its highest level as a percentage, right? Forget dollar figure, as a percentage. And eventually, if that continues, as again, ITR is projecting, eventually something is going to break. Now, fortunately, Charlie, as you mentioned, their projections are, about 5 years from now. So there is time here. We're not, to your point, saying or telling people to get out of the market and, start shifting, but it's more a matter of creating some sort of roadmap to those 5 years or so.
Yeah. Yeah, and it is true. It's definitely 5 years away, but we all know. I mean, we just entered 2025, and it felt like yesterday it was 2020 that we went through COVID.
Yep.
So these things happen fast. And to Peter's point, this is not really to panic anyone. It's not thinking about it. And what I mean by that, just think about it. If you're a younger generation thinking about buying your first house with the intent, well, I'm going to buy my first house, flip it in a couple of years because real estate prices are going to go through the roof, and I'm going to buy something bigger. Well, wait a minute. We may have to rethink that process, because if we're going to hit a 2030 depression, at least in ITR's eyes, they're saying real estate's probably going to level off for about 6 to 7 years before you see any appreciation in housing. So you need to think about what your longer term plans are. So again, I think you really need to think about, and this is where we spend so much time with our clients, Peter, helping them figure, where are you in your life? Right. Let's talk about where we are in your life and where you want to go. And where's that horizon? Is it 6 years? Is it 10 years? Is it 20 years? Because that's really going to play into how we start shaping the vision and the plan for our clients.
Yeah, again, I mean, there's a saying, preparation is separation, preparing for all those items and ultimately creating a plan around it. I mean, as you know, it's all comes down to the cash flow projections that we do for all our clients, anticipating any major expenses coming up, but more importantly, planning for the shocks that may occur or the unexpected that may occur within a family.
Yeah. And you know what I'm really nervous about? We have lived through how many years of prosperity? Decades.
Mm-hmm.
Like my children, Peter, your children,
Mm-hmm.
have not really lived through any very difficult times, fortunately. Right. So I don't know how prepared, forget about the financial aspects. I don't know how prepared this country is mentally to go through any sense of, and let's say it's not a depression. If it's not a depression, it's going to be a deep recession.
Right.
And probably the deepest we've ever seen. So we need to talk to our children also about how to prepare for this as they think about their work, where they want to live, what their financial commitments are, how much debt they have. So yeah, it's 5 years away, but it's the things you start to do today will prepare you for 2030.
Yeah, I mean, listen, certainly for our children, but at the same token, it's for our clients who are of our age or older. I mean, listen, let's face it, as investors, we all have a very short memory, right? We don't want to remember. I'm not going to say we don't remember, but we don't want to remember 2007 and 2008. We don't want to remember what occurred during COVID within the markets themselves. What we do want to remember are market returns like we saw last year and so on. The issue is we start to make decisions that we normally may not want to make or really think it through. So for instance, imagine your portfolio, right, for the most part is up 20% last year. Well, now all of a sudden you have all these additional dollars that you see, right, on paper, and now you may be extending yourself in ways that you normally wouldn't. So
Mhm.
as you know, our job is to really keep our clients in line and in check to simulate and show, well, what would the situation be if the market did drop 30, 40, or
Yeah.
even 50% on the
Yeah.
following year?
Yeah. And those are all such great points. And I said coming into this, we're going to have future podcasts to talk about more specific strategies, but things that Peter and I do think about, and some of them are consistent with our overall philosophy and always been. For instance, when it comes to fixed income, people for some reason say, well, let me lock my fixed income up for 10, 15, 20 years. Well, if we're going to go through an environment where interest rates are increasing significantly, the longer your bonds are out in maturity, the more you will suffer price depreciation, not appreciation, but depreciation, and you'll be forced to hold those bonds to maturity, which is why we always opt to stay very short term, very mobile, and very liquid with our fixed income. Also, things you need to really start thinking about, and this is where 5 years may come into play to help. We have so many unrealized capital gains in the portfolios. NVIDIA, Apple, you could name 500 stocks, and they're all going to be significant gains. One area we think taxes will go up is certainly on long-term capital gain rates will go higher. So I think you need to start thinking about, okay, how am I going to get out of these gains or start minimizing my exposure to these stocks or companies in case it does go down 40%. Forget about taxes. You eventually going to have to pay taxes anyway. So you have 5 years to start planning for that. Other areas to think about, again, where's the riskier assets? Just think about if we go through a depression or recession, growth assets are usually much riskier than value assets, the tried and true companies. So again, things just to keep in the back of your mind. And it's certainly real estate. You want to think about making sure you don't have too much illiquid. The name of the game to get through the 2030s, so when you get to the other side, and really this is when real wealth, significant wealth, if you plan, if you listen, if you strategize, will be created for you and for your children by being liquid enough on the other side of the 2030s to buy whatever you want.
Right. Look, we all saw it in 2000, especially in 2007, 2008. 2007, 2008, I know we speak about it, I wouldn't say quite often, but we definitely bring it up from time to time. It was an outright liquidity event. I mean, we saw prices and that of companies that were selling for next to nothing, and we would scratch our heads and saying, how is that even possible? And the reason why it was possible was because for whatever reason, people wanted to sell just to sell, right? It didn't make sense, but the fact that they felt they were liquid at that moment in time gave them joy. Fortunately, practically none of our clients sold because we guided them away from that. But a natural reaction is, let me sell, let me put my money in the bank, and I know it's there. And that's the biggest mistake people make. But if you project out and you prepare for that and have the liquidity ahead of time, then you don't even have to be concerned during that period of time. And so to your point, it's more a matter of being prepared to have a elongated period of time of muted and negative returns, and to outlive that cycle to then be able to take advantage of the next upward trend.
And before we end it, my last concern going through this is people are going to say, yeah, I've heard it before. and ignore it. And it's funny, we tell that to clients so many times. Yeah, we heard it before. It's different this time. It's not, but it really is never different. We sincerely think this time will be different, and we need to prepare for it. And again, the concern is people, especially advisors that are coaching their clients, say, don't worry about it. These are just two guys trying to get you money. Well, I would suggest look up ITR economics yourself, read their literature, read the background in ITR economics, then start to listen to what other economists now are starting to say. And you're going to start hearing very similar types of forecasting as we get closer to the 2030. So again, our job is to help prepare you. No panic, no jumping out of the window, but we're certainly going to continue to give you strategies and thoughts as we get closer to 2030. So certainly always feel free to reach out to us. We have so many great resources on this topic. So we appreciate you, as always, you listening, and we look forward to seeing you on our next podcast.
To connect with Charlie or Peter, visit them at yourpathwaystowealth.com or call them 631-777-1030. That's 631-777-1030. The material and the opinions voiced are for general information only and are not intended to provide specific advice or recommendations for any individual or entity. To determine what is appropriate for you, please contact your financial professional.